While most 11-year-old children are worried about games, playing in the street, or school homework, a skinny and focused boy in the year 1942 in Omaha was making a decision that would change the history of global capitalism forever. His name was Warren Buffett, while the world was bleeding in the midst of World War II, and adults were panicking over the imminent collapse of the economy. Young Warren walked into a local brokerage firm, put his hard-earned savings on the table, and bought his first 6 shares of City Service Preferred. He didn't do this on a whim, out of luck, or because of a hot tip from the radio. He did it because, even before entering his teens, he had already discovered a mathematical and behavioral pattern that 99% of adult Wall Street investors spend their entire lives without ever understanding. How did a child manage to crack the stock market code during one of the darkest times in history? Today, we are going to reveal the forgotten story of Warren Buffett's first financial move. We will deconstruct the secret strategy of an 11-year-old, the brutal mistake that almost wiped out his net worth right at the beginning, and the definitive psychological lesson he extracted from this experience to build an empire worth nearly $1 trillion. Most people fail in investing because they try to learn overly complex strategies created by computers. The greatest lesson from the greatest investor of all time was learned when he was still wearing short pants and didn't have a penny in his pocket. If you want to shield your mind against market traps and learn to think like the Oracle of Omaha did in his childhood, subscribe to the channel right now and turn on the bell. This is episode 11. The first step to understand the scale of Warren Buffett's achievement. We need to go back in time. In 1942, the United States had just entered World War II following the attack on Pearl Harbor. The mood on the streets was one of extreme pessimism. The stock market was falling day after day. Newspapers blared terrifying headlines, and experienced investors sold everything they had, consumed by panic and fear of the future. But young Warren had an invisible advantage. He didn't consume the political noise of the era. Since age 7, he had been reading every finance book he could find in the library of his father, who was a stockbroker. He spent hours drawing manual charts and counting people's footsteps on the street to understand consumer patterns. While adults stared at the fear of war, Warren stared at the numbers. He realized that City Service Preferred was trading at a ridiculously low price just because of the general panic, and not because the company had stopped being useful. He gathered $114, a fortune for a kid back then, accumulated by selling bottles of Coca-Cola door to door and delivering newspapers, and bought 3 shares for himself and 3 for his sister Doris. He understood, at age 11, what many economists with PhDs forget. The market fluctuates because of human emotions, but real value is determined by static fundamentals. Right after the purchase, the market handed the young investor a severe test. Shares of City Service, which he had bought for $38 each, plummeted to $27. Imagine the pressure on an 11-year-old child seeing nearly a third of his childhood savings vanish in a matter of weeks. His sister, Doris, reminded him every day on the way to school that they were losing money. It was Buffett's first stress test. He felt firsthand what his future mentor, Benjamin Graham, would call Mr. Market, a manic depressive entity that tries to force you into making wrong decisions through fear. Warren didn't sell. He held on to the shares, enduring the daily pressure. Eventually, the market calmed down, and the stock climbed back up to $40. Relieved and anxious to get rid of his sister's nagging and the feeling of loss, Warren sold the shares, locking in a total net profit of just $5 after fees. He felt like a hero for a few days. After all, a child had beaten the market in the middle of a war and come out with a profit. But the real market still held the most brutal and valuable lesson of his life. Shortly after Warren sold his shares for $40, Citi Service Preferred skyrocketed astronomically. The stock went from $40 to $200 per share. If Warren had possessed the patience to simply do nothing, his shares would have been worth thousands of dollars, an amount that would have accelerated his wealth-building plan by a decade. Looking back, Buffett realized that his $5 gain was actually a massive loss in opportunity cost. He realized that an investor's biggest mistake is not being wrong about a company, but rather being right and lacking the mental discipline to hold the asset for the long term. He sold solely to relieve short-term anxiety, sacrificing long-term generational wealth. This historical anecdote is the bedrock of everything Berkshire Hathaway is today. Buffett often says this was the cheapest and most important lesson of his career. He learned at age 11 what Wall Street tries to hide. A successful investor is not the one who makes the most trades, but the one who has the courage to sit on a good idea and let time do the heavy lifting. The strategy Buffett used, and that nobody copies, was not a mathematical algorithm, but rather the theory of cumulative knowledge. From a very young age, he realized that information works just like compound interest. The more you accumulate today, the smarter you become tomorrow. He didn't rely on guesswork. At age 11, he was already reading the reports coming off his father's desk. He looked for businesses that had what he would later call a temporary economic moat. Companies that provided services people couldn't cut back on, like utilities or infrastructure, regardless of the war. The secret strategy was radical simplicity. Buy something you understand for a price lower than it's worth, and forget that you own the asset for a few years. In today's world, saturated with instant trading apps and real-time notifications, Buffett's patience at age 11 seems like an alien superpower. Nobody copies it because our digital culture was designed to turn us into Doris, the anxious sister demanding results every single second. If we analyze today's finance influencers, they all preach speed. Get rich quick, day trade, use leverage. Young Buffett proved the opposite. He understood that speed destroys wealth. Delivering newspapers every morning through the streets of Omaha, he learned the geography of local businesses. He saw which stores were always packed and which ones were failing. He used empirical observation when he bought Citi Service. He applied the logic that people would continue to need energy and fuel to move the country. He ignored the radio analysts of the time who predicted the end of the world. This mental isolation is the exact same thing he practices today in his armchair, reading paper newspapers and ignoring the Twitter feed. Buffett's mind didn't change from age 11 to 95. It just gained more scale. The boy who sold chewing gum and counted bottle caps to see which soda sold the most is the same man who today buys billion-dollar stakes in Apple and Coca-Cola. The regret of selling Citi Service too early shaped Berkshire Hathaway's acquisition policy. Today, Buffett's favorite holding period for a stock is forever. When Berkshire buys a company, it promises the original owners that it will never sell it. This gives Berkshire an absurd competitive advantage. The best businesses in the world want to be bought by Buffett because they know they won't be chopped up or flipped to vulture funds during the next crisis. This entire empire of stability was born from the trauma of an 11-year-old child who missed a stock rally from $40 to $200. Buffett turned a childhood pain into the greatest corporate fortress on the planet. He understood that market volatility is your friend, not your enemy. The chart might drop today, but if the company is solid, it will rise tomorrow. To apply the strategy Buffett discovered in his childhood, The modern investor needs to go through a digital and mental detox. The rule boils down to 3 practical steps. Buy with sweat equity. Buffett used the money he earned delivering newspapers and selling Coca-Cola. When money costs your physical time, you don't throw it away on stupid internet bets. You respect it. Ignore peer pressure. He failed because he listened to his sister's daily complaints. In investing, you must be a lone wolf. If you look around or check online discussion boards, you will sell at the bottom and buy at the top. Focus on utility, not price. Price is what you pay. Value is what you get. If the company provides an essential and indestructible service, today's stock price doesn't matter. The speed at which the world moves today makes Buffett's analog strategy even more lucrative. Because everyone is trading in the ultra-short term, long-term assets get forgotten and cheap, ready to be harvested by anyone with the mindset of that boy from 1942. Financial anxiety carries an invisible cost to both your health and your wallet. An investor who checks their balance every hour suffers daily micro-traumas that destroy their capacity for logical reasoning. Buffett shielded his mind against this very early on. After the mistake with his first stock, he promised himself he would never let other people's fear dictate his actions. He developed an almost surgical emotional detachment from the numbers on the screen. If the stock market closes for 5 years, Buffett doesn't care because he knows what he owns. He doesn't invest in floating pieces of paper. He invests in real businesses made of bricks, people, and brands. The newspaper he reads every morning serves to remind him of the slow flow of human history, contrasting with the frantic noise that destroys fortunes. Why does the 11-year-old strategy remain the secret that nobody copies? Because it requires you to accept getting rich slowly. Deep down, people don't want Buffett's strategy. They want Buffett's money, but with the speed of a lottery ticket. They don't want to spend their childhood selling gum door to door or spend hours reading reports without interruption. Warren Buffett's secret isn't an ultra-secret mathematical formula from Wall Street. The secret is his unwavering ability to control his own temperament. His genius is not cognitive, it is emotional. He learned, in the most painful way possible, that the market punishes the impatient and rewards the disciplined. The magic pill of financial success was discovered by an 11-year-old child in Omaha, in the middle of a world war. Buy value, ignore the panic, and have the patience to do absolutely nothing. The next time you feel the temptation to sell a good investment just because the price dropped a little, or because someone on the internet said the world is ending, remember the boy Warren Buffett in 1942. Remember the regret of selling too early, and the price he paid for listening to the noise of fear. Ask yourself, am I acting on logic or on anxiety? If this episode helped you understand that temperament matters more than IQ in investing, leave a like and comment below. 1942 Mindset. Don't forget to subscribe for episode 12, where we will reveal the 3-page document Buffett uses to evaluate a billion-dollar business in less than 5 minutes. In the capital markets, those who run get tired. Those who wait get rich. Until the next story of value.